Okay. Okay, we're gonna we're gonna start in a bit.
Excuse me, Mr. Norris, if I can ask this question, how are we going to look at finals? Is it going to be done online or in person?
Okay, good afternoon. Good evening again. Let's get started at 6:15. I guess the others will join us momentarily. I'm a little bit under the weather, but I'll do my best. Okay, so see my little note is coming up again about unstable internet. One of your colleagues sent in her apologies earlier. So we'll at least be down by one person
Okay.
tonight. Okay. Okay. So just do a quick review of today's lesson. I mean, previous lesson from last Thursday, and then we get into today's lesson. So we did a class exercise on Martin and Cherry role case study. We did a net worth on them. So we got the information from pages 101 and 105. We completed the net worth based on the information we have been provided. And we came up with a net worth. Then we did Benjamin Bain. We did another one similar to for net worth exercise, similar to the rules. This one by Mr. Benjamin Bain. We looked at the information provided on him, and We completed his net worth. The only thing we didn't do with him was to say whether or not his net worth was positive or negative. So, so would you say his net worth is negative or positive?
I would say his net worth is positive because his liabilities are way less than under all of his assets.
So his net worth is positive then?
Yes, sir.
Yeah, okay. Yes, so we didn't answer that question last class. Is this net worth negative or positive? So we then, well, that ended the section on character. And then we we began looking at ability, the A in Campari. And we mentioned that next to character, that ability was probably the most important component of credit assessment we are considering. Okay, so character, ability. Some versions of Campari have amount as the second, as the first A, because we have two A's there. So we have ability and we have amount. I have deliberately chosen to put ability next because I was trying to rate the importance of ability over amount. So I put amount at the end. Unfortunately, we couldn't do anything with I, insurance or collateral. And as I mentioned in a couple of previous classes, you should be able to make a proper assessment on someone with something I call the big three. That is character, ability, and insurance, or what we call collateral. Another word for insurance is collateral. Okay, so if it is clear that the client cannot pay, then the decision should be to decline the loan. And then I refer to the ABA's chart, flow chart on doing on processing a loan application. So we looked at, or at least we began to look at two areas: debt service ratios and income confirmation and calculation. So we first looked at debt service ratios, and we said that there were three debt service ratios. There was the consumer debt service ratio, the gross debt service ratio, and the total debt service ratio. The consumer debt service ratio being consumer loans and credit cards, and the gross debt service ratio being your housing, the housing portion of the debt, the amount of the ratio that you spend on housing, whether that is rent or mortgage. And then, of course, the total debt service ratio will be the consumer debt plus the gross debt will give you your total debt service ratio. And as it shows here to the bottom, since I made that correction, that the total debt service ratio should not exceed 45%. That is guidelines set by the central bank. That is also international guidelines from the international financial services industry. So if you wonder where central bank got that figure from, they just didn't, come up with it themselves. They considered what was the industry standard around the world, and so they measured it at 45%. So you see TDSR 45, CDSR 10, and GDSR 35%. Then we looked at how it's calculated. First, we look at how the gross debt service is calculated, and then we looked at how the total debt service ratio is calculated. And then we used a little example there. And we first worked out the gross debt service ratio, and then we did the total debt service ratio. We didn't work out the consumer debt service ratio because, as I said, in most cases nowadays, we just consider the total debt service ratio when we look at the consumer loans, because customers' debts are so high, the ratios are so high that it even crowds out the 35% housing debt service or the gross debt servicing. So, and then we only really look at the gross debt service ratio when we're looking at mortgages, because we want to see how much the mortgage payment is going to be as a part of the overall debt. So basically, consumer debt servicing has looked like been pushed aside to some extent. Gross debt servicing has been set aside unless you're dealing with a mortgage. And in most cases, we look at total debt service ratio. But when when we have to deal with the credit bureau, or they should, I have not seen any reports yet from the credit bureau. But if they are, the same standard as, the universally ones, TransUnion, Experian, and the other credit bureau in the U.S., Canada, and elsewhere and around the world, they should follow a similar pattern. And so CDSR, GDSR, and TDSR would be a factor in those. Then we said there were some questions to ask ourselves. I think there was a total of 6. They're not all in all. There should be some more questions you could ask yourself, but these are just some of the few questions to ask yourself. Okay, so are the debt service ratios within our guideline for the amount and term requested? Can the client meet this debt and total obligations? Have you verified the numbers to ensure all is correct? That is, you have not mixed weekly figures with monthly, etc. About that and how that plays a part with some financial institutions will use it, particularly when there is a construction mortgage involved, simply because for the first few months, probably up to 6 months, the client would probably only be paying interest only. So their full blended payment of principal and interest will not come into play until the building or structure is completed. And so if that payment that they have takes them over the debt servicing, you can exclude that, so that if that would bring them in line. Not all banks do it. A few banks policies and procedures. Does the client have the necessary self-discipline? Again, we see that has pretty much fallen out the window because we rely pretty much on deductions and assignments, salary deductions and salary assignments. But again, we can look when we look at character, and we were looking at payment history and the different sources of payment history, including some of those credit sources of history, such as regular savings, paying premiums on life insurances, etc., or building up equity in property. We can see whether or not a person has discipline historically from their past payment history. And then, of course, we looked somewhat briefly, not too much detail, at what stage is the borrower in his or her credit life. And we looked at 4 phases. And we mentioned that some wealth managers or financial analysts, they say there are 5 phases of an adult's financial life. and that's because they start at age 18 or the teenage years. I start at age 25, basically when people are back from college and have had some time to work, or they may have had more than 4 years of college, and they've come back and accumulated college loan debt. So I started at age 25. That's my personal preference. And we said between 25 and 34 is when consumer debt is at its highest. And then between the ages of 35 to 44, you look at the borrowing days peaking. That's when people get into mortgages, asset acquisitions, getting into their own business, the children's college loans, if they have to get loans, aging parents, and any borrowings that may be associated with the parents, where particularly where parents may not have the necessary funds to cover their own medical expenses. So it peaks between 35, 44, or 45. And again, these are not absolute. So you may find in some real instances, the debt borrowing days may stretch earlier than 35 and into close to age 50. But these are just kind of basic guidelines that you would want to advise your clients, that when they're getting into to planning their financial life, that these are some of the things that they should observe as much as possible. So the age 45 to 55 is when debt should be subsiding. There's more of a concentration on asset protection and retention. And that's when like cash surrender values and insurances, trust accounts become more important. And then you find people, particularly those who might be involved in mutual funds or those type of things, they tend to get into the funds that are less risky. So they may move them from more of the bullish type investments to the more bearish type investments. Then at age 55 and over, you have asset utilization. And that is when you begin to use your accumulation of wealth, or you even begin the disbursement of it, or at least you consider, dispersing some of it. So retirement years, giving gifts to heirs or charities, et cetera, et cetera. And some people, even during their lifetime, will set up a foundation so that even after they're gone, the foundation will be funded, hopefully by family and friends, long after they're gone. Then we looked at the actual chart. Again, I said I used straight lines as opposed to curves. And I think I sent one or two to you via email where they are curves. And those are more realistic. What I tend to do with my graph is mine is more for emphasis and illustrative purposes, more so than being showing a truly realistic approach. So rather than being straight up and straight down, there'll probably be a U-curve kind of thing, right? So an upside down U-curve. So that is red. You see that peaking again in that 35, 44 year lifespan or time frame, and decreasing as the person goes into retirement. And of course, savings and investments should be increasing over time. So that ended that. And so then we went into income and debt service ratio calculations, looking at the incomes and what part the incomes play in the terms. Okay, so we had looked at debt service ratios, how to calculate them. And we just simply said about the gross salary. And so this is where we begin looking at how we arrive at the gross salary as opposed to net salary. Okay, and so we said that salary for salary income or salaried income, you use 100% of the primary job for each borrower, and this is a three. It's a very short phrase, but it was a fill in the blank for on purpose, because salaried income. The first point to remember in salaried income is we use 100% of salary income. We use 100% of the primary job. So primary job is the second point to remember. And salaried income for each borrower. So if you have two or three borrowers, two or more borrowers, you use 100% of the primary job for each borrower. Okay. Then we looked at gratuities, tips, and bonuses. Gratuities and tips are used interchangeably. And then, of course, bonuses. So we said we use 50%. Then on second jobs, we said we use 50% of second jobs. Rental income, we use 50%. Commissioned income, we use the average of the last 3 to 5 years earned commission, but it must not exceed the current years. And then we did a little exercise on that. Review again in a few minutes, or in a minute. Then we said if the client is paid weekly, we multiply the amount by 52, then divide by 12 to arrive at the monthly amount. And we said we do that because if we just simply say there's an average of 4 weeks in a month, we could end up shortchanging the client, because 4 times 12 comes up to 48. So we will even be we'll be shorting them by a whole 4 weeks if we chose that route. If the person is paid every 2 weeks, we multiply the bi-weekly salary by 26, because there are 26 pay periods when a person is paid bi-weekly. Then we divide by 12, that is 12 months of the year, to arrive at the monthly amount. Then we looked at gratuities and tips, and we said if the average annual tips or bonus equated to $530, 50% of that, which is $265. Then we looked at rental income. We said if no unit is owner occupied, in the case of a duplex, and let's say, for example, the monthly rent is $700, then we say 700 multiplied by 2, because there are 2 units, gives us $1,400, but we use 50% of it. So we divide by 2 or take 50% of it, which is $700. If it's a triplex, and the rent, we're using the same example, $700 monthly. We multiply that by 3, gives us $2,100. We divide that by 2, and that becomes $1,050. And of course, if it's a fourplex, and similarly, if one of those units is owner occupied, then what we do is we use 50% of the $700. That is the rent from one of those units. Therefore, we'll only use $350, as opposed to if it was not owner occupied in the above. The triplex, again, if one of the units is occupied, that means you only get rent from 2 units. That's $1,400. We divide that by 2, or we multiply by 50%, and we get $700. We then turn our attention to commissioned income. And this is where I said earlier, we'll take a look at it in about a minute or so. So we look at two scenarios. One scenario where the current year's commission exceeded the average, so we used the average. And then in the second instance, it's where it was less, so we used we used the most recent year, okay? Because we said it could not exceed the most recent year. All right. And then of course we did the calculation of the weekly salaries. If the salary is $400, then we say 400 multiplied rather by 52. That gives us 20,800 annually. Then we divide that 20,800 by 12, which gives us 1733.33. And then again, I re-emphasized not to do it the way to the bottom. Okay, do not do it the way to that's listed at the bottom. Okay. Then we look at biweekly salaries. This is where we ended. If the biweekly salary is $800, then it's 800 multiplied by 26, because there are 26 pay periods where there are biweekly salaries every 2 weeks. We come again with 20,800, divide by 12, that gives us 1733.33. Okay. Any questions on that before we go to the next lesson? Well, to today's lesson. Hello. Hello, are you there?
Yes or no? I don't have any questions.
Okay.
I'm okay.
Okay. All right. So let's move to today's lesson. Okay. So let's go to page. This would be page on rents. Yes. Okay. That's page 32. Page on rents. Okay. So with regard to rents, we said that if you are considering a lot or consumer loan, you have to include rent payments. That is, rent that the client pays. Okay, this is not rental income. This is rental payments, rent paid. Okay. And then we say exclude if you're considering a residential mortgage of some sort, or residential investment mortgage, where the client is going to live in one of those units, or the client is going to live in the rental property, the house, if it's a single family house. The reason we include, if they come for a lot loan or consumer loan, is because they still have to end up paying rent. They still need somewhere to live. Whereas if the proposal before you is a residential mortgage or residential investment mortgage that they're going to live in, you exclude any rent that they would pay, because the rent would fall away and the mortgage payment will take its place. Is that understood?
So if it's a mortgage, then And if you're renting, or if you include, if,
Could you start, because I think I lost you momentarily. You said if it's a mortgage,
okay, if it's, because I'm reading from off the screen, if a lot or consumer loan is being considered, then rent payment should be included in that.
yes, rent payment should be included.
And if it's a mortgage, then you exclude it.
And then if they're getting a residential mortgage in which, and the property, they're going to live in that property. If it's a single family or multi-family, and they're going to live on that property, then you exclude it, because they won't be paying rent anymore. They'll be paying a mortgage. However, now, if they're buying,
You dipped out, sir. Can't hear you. Anybody else hearing Mr. Nordich?
hello, can you hear me?
You just came back in, sir.
Okay.
You said, however, everything else went blank after that.
Yes, okay, it seems as though internet is poor today. Okay, so I said, however, if they are getting a residential mortgage or residential investment mortgage, and they are not going to be living in that place or any of the units, then they still be paying rent somewhere, then you include the rent payment. In today's environment, where there are Airbnbs, people may buy a single family home and rent it out as an Airbnb, or they may get it as a second home, right? So you could have a single family residence. I know of people who pay somewhere else the mortgage that they were sorry, the rent that they could get for their residence was more. They received more from the residence than they would pay somewhere else. So let's give it for an example. Let's say that they could get $1,200 rent for the house, and they could pay $700 somewhere else. Hello, I think we ended up reconnecting. Hello.
Yes, sir.
Can everyone hear me?
I know I can hear you now, sir.
Oh, the connection is poor. Okay, let me bring up the PowerPoint presentation again. Can everyone hear me?
I know I can hear you, sir. I don't know about the ladies.
Okay. Okay, the internet connection is not all that hot today.
Okay.
Can everyone see the screen?
I can see it, sir.
Yes, sir.
Yes, sir.
Hello?
Several of them said that they can see it, sir.
Okay. Alrighty. Okay, so I'll go over that again. Again, I apologize. the internet connection for some reason is renting their homes or their duplexes out or other investment properties as Airbnbs, or they even find themselves that they can get more rent for their property than they would spend renting somewhere else. And so I began to say, for example, let's say that they can get $1,200 a month for their house, and they could rent somewhere else to live for $700. Okay, that means that they will be netting $500 more. So it makes sense for them then to rent from someone else at $700 and rent out their place for $1,200. Okay. Now, if you have a case where that is happening, then you'll have to include the rent as well as the mortgage payment, because they're paying the mortgage payment for the residential mortgage or residential investment mortgage, and they're also paying rent somewhere else for themselves. Is that understood?
Yes, sir. I understand that. I get it now.
Okay. I'm hoping your colleagues can also hear, because move on to the next point, but I'm not going to spend any time really on it. This is one, loans being paid off in 4 months or less. Again, I mentioned if it's a construction or residential mortgage that is being granted. I won't get into the whys and wherefores concerning that, because most financial institutions do not get into that or do this. And normally that is reserved for more advanced class in any event. So, but what is more important than that is determining the monthly credit card commitments or exposure. Okay, and so most credit cards, their minimum payments are between 3 to 5% of the credit limit, and you'll see that limit is all caps. Okay, because it's between 3 to 5% of the limit. There was a time when it used to be 10%, and then it went down to 5%, and most credit cards are now 3%, but there are one or two that still request 5% minimum payment of the limit, not the outstanding balance. Okay, so when we're calculating debt service ratio, we use this 3 or 5% of the credit limit despite the outstanding balance, because the client has the ability to take the card up to the limit at any given point in time. Okay, so the client can get that card today, is at zero balance, they can max that card out today. And so for that reason, that banks, when they're calculating debt service ratios, they use the percentage of the limit, not the outstanding balance. Everyone understands that?
I think I do.
Everyone heard that explanation? Okay.
Yes,
So
sir.
we're going to do some examples, and it'll become clear as we do the examples later on. Okay. Okay, so we move on to income confirmation or verification. And we have a fill in the blank here. For employed individuals, make sure that the salary income confirmation is verified rather than taken at face value. Okay, so the first thing you want to do is make sure that the salary income confirmation is verified rather than taken at face value. So if they tell you, I make $2,000 a month, you have to verify that. Next, you must ensure that the employment confirmation letter is on the employing company's letterhead and signed by the appropriate personnel. Okay. Well, let me get to the next point first, and I'll tie this and the third point together. Then you want to verify the information contained in the employment confirmation letter by calling the company and speaking with the appropriate authorized party. Now, the reason for this is that the employment confirmation letter, with today's everyone being so computer savvy and companies' logos and whatnot are so available on Google and the internet in general, that there's the risk of a lot of fraud going on. Okay, so people may fraudulently bring in a employment which they want you to believe is an employment confirmation letter. Okay, so that's one aspect of it. Okay, committing fraud by duplicating the company's letterhead. The second is that they may have a friend in the company who will do the letter for them and sign their name as though they were the authorized party. Okay, and particularly when you see it's being signed for the HR manager or for the manager or for the owner. Okay, on behalf of the owner. Okay, if the actual person in charge is not the person signing, you definitely want to call the company and and don't ask for the person whose name is down there as the HR manager or owner, right? Just ask to speak with the owner or ask to speak with the HR manager. Okay, because if you ask to speak with Mr. Nottage and I'm the one who my name's at the bottom there, it could be a setup. And so they send a call to me, and then I'll be able to say, oh, yes, they work for us, blah, 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 blah. Okay. So what you want to do is you want to call, find out who the human resource or the personnel, HR personnel manager is, speak with him or her, and go from there. Okay. Any questions on that?
I'm good. Be recording, so I keep my opinions to myself.
Okay. So let's look at the income confirmation verification, which should be on the contained in the letter or on the letter. Okay, so first of all, employment confirmation letter should be on the company's official letterhead. Okay, again, we talked a bit about that a few seconds ago, how to verify that to some degree. Some of them, it is obvious that they have copied it. They've manufactured one of their own. Some companies are very strict on the location of their logos, the colors of their logos, the size of their logos on their letterheads, etc. So some of them to the right, some of them to the left, some of them in the middle. Okay, so if you know that, for example, that you expect to see a company's logo from this particular company, the ones that you've received are in the top right-hand call them and this one comes left for suspicion. Okay. Secondly, it must have a current date. And then, of course, your financial institution will say whether it should be no longer than a month old or 3 months old, whatever. Okay. So whatever current date that your organization says is the current date, that is the current date that you look for. So it's nothing older than a month, or nothing older than 2 months, or nothing older than 3 months. Again, be guided by your company's policy on it. Thirdly, it should have the position of the employee. Let you know that the person works as a carpenter or whatever the case may be. Okay. This is also important. The commencement date of employment. The commencement date of employment, because you also want to verify if someone says they've been with this company rather for 8 years, the commencement date should show a date that corresponds with them telling you they've been employed for 8 years at that company. Fifthly, it should indicate that the employee is currently employed. Now, I know sometimes we have people who are not so good with English language, so the smaller businesses. So, but you still need to watch out for some key things. So if they say Mr. Norwich was employed with us, from 2015. Okay, look at that word "was." Okay, it could mean that they were trying to tell you that, okay, I came to the employment back then, and I'm currently now, but still watch out for those little words and stuff. Okay, whether the past tense, current tense, they were employed. They should say he is employed in as such and such with us, and he's been with us since such, or she has been with us such and such a time. Okay, and again, if you're in doubt according to the wording, call the company and then ask to speak. May I speak with Mr. Norwich? Oh, Mr. Norwich won't again no more. He ain't been here he been gone 3 months ago. Okay, so there's a way to check it. It should state the employee's income. Okay, and if that income is salaried income, it should state what it is on a monthly basis or annual basis. If it's a base salary and some commissioned income or tips and gratuities, it should indicate the level of commission or the level of gratuities. And I know with Atlantis, they used to state what the average gratuity is, either weekly, monthly, or they would state, last year the gratuity earned was such and such. So again, be guided on how some of these companies word it and what is acceptable to your company to confirm the different types of income. And of course, it should have the signature and position of the person who's actually signing the letter. Okay, and of course, the employment confirmation letter isn't the only source that we use, because we also request salary slips or payment slips, and we examine those payment slips for the salary to make sure that the level of salary that they get on those weekly or monthly pay slips correspond. And also a lot of those salary slips or payment slips, income slips, show any deductions, particularly persons employed in the hotel industry and with government. Okay. And so any questions on that? income employed individuals.
I'm good. I'm good.
Okay, so let's look
No,
at.
sir.
Sorry.
No, I was saying that I don't have any questions on that.
Okay, so let's look at income for self-employed individuals. Okay, so for self-employed individuals, ideally, okay, all right, my apologies there. Okay, so self-employed individuals and corresponding bank statements must be obtained in order to assess income. Okay, so that means that if their financials, we're looking at year 21, 20, 2019, we need to have the bank statements for those 3 years. And of course, because we're well into 2022, if they have any interim financials, you'd want to look at those interim financials, and most definitely the statements up to the end of July. Okay, because we're now in August. Okay, because you with those bank statements, you want to compare. For one thing, you want to compare the level of deposit activity. There should be some correlation between the level of deposit activity in those bank accounts to the revenue that is declared in the financial statements. So, for example, if the person declares that their gross revenue is $400,000 a year, the bank statements should kind of reflect that, give or take a few dollars. Okay, I've looked at recently at a financial statement and bank statements where the person indicated that the financials stated that their gross revenue or gross revenue was at the 400,000 level a year. But when I looked at the 3 years bank statements, I could only verify a little less than 50% of that. I got like 190-something thousand in their best year, right? So so then I began asking questions. Okay, now what you will find, and many of you may not get into the self-employed, but just for reference and even for your own edification, if you intend on getting into business, a lot of Bahamians make the mistake, a lot of Bahamian business persons make the mistake of not letting all of their income pass through their financial statements. So, for example, if I have a clothing store and I sell a dress, and that was $120, I go and I say, go pay my electricity bill or my telephone bill, it's $120. No, what you do is, if you have to do a petty cash entry, you do a petty cash entry that shows that you took out $120 from the till to pay a bill, right? And even at that, I would not recommend that unless it's a business expense. And that's another weakness of Bahamian businesses. We mix our business and our personal finances. We commingle them, and we're not supposed to be doing that. Pay your personal bills out of your salaried income from that business. Okay, so let's see, statements. Oh, another thing that particularly since we've come out of COVID, some banks would want to see go back 5 years. So they want to see the 2 years pre-COVID. Okay, so, but all things being equal, the most 3 recent years should give you a good history. But because of what we've just recently experienced with COVID, some financial institutions may ask for 5 years because they want to see the 2 years pre-COVID. Okay, because a lot of businesses didn't do too well. Some of them folded up during COVID. So ideas and corresponding bank statements must be obtained in order to assess income. Again, similar to commissioned income, the average of the 3 years is to be utilized as the present income. However, this amount cannot exceed the most recent year's income. Okay. In the past, we were challenged, particularly when I was doing a lot of self-employed persons in mortgage lending about 15 to 20 years ago. Record keeping by businesses was hardly ever done, or not done at a sufficient level. A lot of times we had to put things together, or have the client go and have an accountant put stuff together for them. However, since most businesses, well, if not all businesses, are now required to provide financial statements in order to satisfy annual renewal of business licenses, or for VAT purposes, because even those who are excluded because they pay under $100,000. I mean, they make less than $100,000 a year, right? Their business generates less than $100,000 a year. They may be excluded from submitting VAT disclosures on a monthly basis. They still have to show on an annual basis that their business has not generated more than $100,000. So the Internal Revenue Service should be getting, for all businesses, whether they are under $100,000 or over $100,000, they should be getting declarations at least once a year. Because unless those are submitted, annual renewal of business licenses will not be forthcoming. Okay, and these financial statements must be signed off by a certified accountant. Okay, any questions on that?
I'm good.
Okay, so let's look at like we did with the commission income. Let's look at some example, 2 examples as we did with commissioned income. So for self-employed, if in year 1 they made 61,000, year 2 they made 63,000, in the current year they made 65,000. That totals 189,000. We divided by those 3 years, and we get an average of 63,000. Do we use the 63,000 or do we use the 65,000?
65, right? That's the last one.
Okay.
2019, right?
Okay, let's go back where it says. Remember also what we said about the commissioned income. Point number 2, the average of the 3 years is the average amount cannot exceed the most recent year's income. So you want to look at your answer again? Reconsider the answer?
No, we can't use it. This is similar to when we're using commission, right?
The average is 63. The current year is 65.
So we have to use 63 because now I see it. The 65. You can't use a 65 because it exceeds the average.
Yeah, okay, but I think you were breaking up. I just heard the last part of 65 because it exceeds the average.
Yeah,
so you don't mind?
because you have to take the average And if the last year exceeds that average, you can't use that. So you'll have to use the year before, which is a 60K, 63K.
Exactly. So the average is 63, but yes, the most current year is 65. 65 is more than 63. So we can't use the current year, we use the average. Let's look at B. Year number 1 is 65, year 2 is 63, year 61, year 61K or 61,000. Again, the average is 189,000. We divide by 3, so we get the average of 63,000. What do we use? Do we use 61?
Yeah, we can use 61 because the 61 doesn't exceed the 63, which is the average over the 3 years.
This is over 3 years. Do we use the average or do we use the most recent year?
Use the average, right?
Remember we said it must not exceed. So the average exceeds.
No, it doesn't. I don't think it does. If I'm understanding this
Okay,
correct.
the most recent is 61,000.
Okay.
The average is 63. So would you use 61 or would you use 63?
$61, I guess.
You would use 60, you would use 61. Because the average exceeds that, right?
Yes, sir.
Okay, why else might you want to use 61 as opposed to 63? Look at what's happening from 2017 to 2019.
There's a massive decrease. He's slowly going down.
It's yes. Okay, the income is decreasing. So that's another reason you would want to use a higher figure, because maybe the current year or the following year it may be 60 or 59. But then again, it could probably go up to 63. Okay, but it all depends. Okay, it all depends, and so that's when you need to begin asking questions and looking at the financials. So the financials may show you, for example, they may have increased staff salaries, significantly increased staff salaries over those, or their own salary from since 2017, but they have not done anything with prices. Okay, so they have not increased the price of their goods sold, but they've significantly increased salaries. Okay, or production costs may have risen. The cost of electricity may have gone up sky high. And again, they have not adjusted their prices because they felt it was, they would make a smaller profit margin, but at least they'll stay in business until they could, they just want to weather the storm. Probably until they could find another alternate source of power. So maybe they're coming to you to borrow to get solar panels to convert to solar, and so then I would eliminate or drastically reduce the electricity costs. You see, so again, it's all relative to you're taking a deeper dive to see what is happening. So it's not necessarily a a bad thing on the surface, but when you take a deeper dive, you may see that there may be some logic behind doing it. Is that understood?
Yes, sir. I think I grasp it now.
Okay. So we're getting ready to do some calculating exercises that are on exercises 1, 2, 3 that are on pages 34 and 35. But before we do that, let's look at some other sources of income. Okay, so so here's some questions you want to ask yourselves when you're looking at other sources of income. How stable are the other sources? Because if they're not stable, you don't want to use them. Okay, are they short term or long term? Okay. So for example, if a person is only going to, they may have a second job, but they only contracted for a year, want a mortgage, and you're looking at a 15-year mortgage, well then, you can't consider that second job short-term 12-month contract as a contracted worker for 12 months as a second job. Are any contracts or agreements held to support income streams? And this is particularly important with self-employed persons. So they may have, let's say, for example, this is maybe a cleaning company like Frank Hanna, okay? And so they may not have, this may be, they may not be as established as Frank Hanna. And so they may not have the financial information that a Frank Hanna, cleaning company would have. So what you want to see is, contracts. So they may have a contract with the government, or contracts with government or government departments, or contracts with, large companies that you could reasonably rely upon, so, they have a cleaning company with A.H. Pritchard or Doctors Hospital or whatever the case may be. Okay, so you want to look at those things to support income streams. Here's a rare one: alimony. Okay, if alimony or support payments are the court ordered and enforced, that is via salary deduction or directly into the courts. I recall years ago, and this would be probably like 25 or more years ago, that a lady came to us at the financial institution I was working at, and she got a pretty handsome amount of alimony from her husband as part of their divorce settlement. She was prominent, a prominent individual, and he was a prominent, well-known business person. And this didn't go through, his payment didn't go through the court. It was, voluntary. He paid as part of the settlement between themselves. So there's no salary reduction or whatever it is. But because this was a person of means, and this is an agreed settlement, and there wasn't, any harsh thing between the two of them. Okay, we reasonably accepted that this gentleman, he was good for the amount of money that he was going to be paying his woman for alimony on a monthly basis. And so, in looking at her loan application, we considered 50% of the alimony, and that was one of those rare occurrences. But again, be guided by your financial institution. Most financial institutions will not regard alimony or child support payments, even if they are by salary deduction being paid directly into the courts. So again, be guided by your bank's policy. Again, we're looking at all possibilities in this course. We're looking at all possibilities, thinking outside the box in a number of instances to ensure that we are exploring all possibilities of helping the customer utilize as many sources of income that he or she has at their disposal. Okay. So any questions on this before we move on to
I'm good, sir.
exercise number 1?
I'm good, sir.
Okay. All right, so let's start with exercise number 1. Okay. So in our book, top of page 34. Okay. We have some information in here. So we have a column that has income, expenses, proposed loan, and then we have a another column over to the far right that shows the amounts. Some of these things are done for us. Okay. So let's start with the first line, salary. The salary is $50,000 a year. And remember we said when we are considering loans, we try to convert everything to monthly because the loan payments are paid monthly. So any salary we get, whether it's weekly, bi-weekly, yearly, semi-annually, quarterly, needs to be converted to a monthly figure. Okay. So you'll see in your books, you should have a top there monthly and there's space so that you can fill in the figures as we go along. So if it's $50,000, it is saying here that on a monthly basis, it's $4,167. How did we arrive at that?
We took the 50,000 and we divided it by 12, representing each month of the year, and then we rounded off the figure.
Right. So is it right? Excellent. Okay, so 50,000 divided, it says that this person gets paid $50,000 a year. We divide it by 12, and that's how we got our 4,167. Of course, it'll be 166.66 recurring. So we just rounded it. We just rounded it up as opposed to showing the cents. Okay. Again, be guided by. In most of this, we won't be using the cents. We'll be rounding up as much as possible. But again, be guided by how your bank may want you to show the exact cents. Okay. So if that was the case, you would say $4,166.67 if your financial institution wants you to show the cents. Is there any other income from this for this individual?
That appears to be it. That appears to be it, sir. Okay,
so what we do is we draw that line under the 4,167, and where it says total income is 4,167 because that's the only source of income. Okay. So we move from income to expenses. And it says that there's a mortgage that is paid $850 a month. Do we need to do anything with that? That's already expressed as a monthly payment, right?
Yeah. That's already expressed as a full monthly payment, and everything is done on a monthly basis so far.
Okay, you were breaking up, and I think I may have been breaking up too.
No, the $850, it represents the monthly charge, so we could just pass that over.
Okay, great. Okay, good stuff. All righty. Okay, this is where it gets interesting. Okay, so remember we said on credit cards we will use either 5%, anywhere between 3 to 5% of the limit. Here they're telling us to use 5% of the limit. Okay, so this person has 2 credit cards. The first one has a $5,000 limit. We use 5% of the limit. They have $750 owing on the card. In that form.
I can take a shot with that.
Go ahead.
I can take a shot. I'm going to take, because if my max limit is, if I'm understanding this correctly, is $5,000. 10% of that is $500, which means if I use 5%, that's only going to give me $250. But I get $750 owing. I'm going to run with the $750 because that's reflecting more of what is owed rather than the 5%. Is that good logic?
Okay, remember what we said, right? Let's go back. Where was it? Credit cards. Where's the credit card? Where's the credit card? Credit card payments. Okay, I seem to have lost it. Okay. Okay, remember we said we use 3 to 5% of the limit.
Yeah. Okay.
Regardless of what is owed.
Okay.
Remember that?
Yeah, I do remember reading that. I was going over that tonight, actually. That would be, that's page 32 at the bottom. Monthly credit card
Yes.
commitment. Yeah.
Page 32. Yes. Determining monthly credit card commitment exposure.
3 to 5%.
Express the monthly commitments exposure as a percentage, usually between 3 to 5%, depending on the card company, of the credit limit. And you see, limit there is bold. And on the PowerPoint presentation, I actually had it capitalized.
Yeah.
The credit limit. Okay, despite or in spite of the outstanding credit card balance, or notwithstanding the credit balance. So it doesn't, if that is zero, if that credit card balance is zero, you use 3 or 5%. If it's in this case 750, use 5% of this credit limit. So what is 5% of 5,000?
250, sir.
250.
250. Yes.
Yes.
Okay. Okay. So now we look at the next one. It says MasterCard, $2,000 limit. They have nothing owing on it, no outstanding balance. It says use 5% of the limit.
That'll be $100.
The
Sir.
payment is 100.
$100. Anyone says anything different? Okay, so $100 it is. Okay, now proposed loan. This is they've come to you for this loan, and this proposed loan they will have to pay $200 per month. What figure do you put in there? Don't overthink it now.
200?
200, yes.
Yeah,
Because we say when we're dealing with loans, we express everything on a monthly basis, so we're converting everything to a monthly basis. So we've already been given what the monthly payment is. Okay. So what would be the total expense?
Okay.
What's the total expense amount for this client?
1,400.
Sorry?
1,400.
1,400, yes. Okay. Alrighty. Okay, so now you might want to go You might want to go back. You might want to go. So if we were doing total debt service ratio, okay, we said that our denominator or the bottom figure would be our gross monthly income, right?
That's correct. 4,000.
So what figure would be to the bottom?
That would be our total
If you-
income.
Yes, what figure would we put to the bottom of that equation?
That would be 4,167, sir.
67, yes. And what would be our numerator or the top number? If you're looking at total debt service ratio.
That would be 1,400, sir.
Okay, because you're looking at a total of this 850, the 250, the 100, and the 200 gives you 1,400. Okay, so let us divide 1,400 by 4,167, then multiply it by 100, and what do you get as your percentage?
I got 33. I don't know if that's right.
33.59.
33 flat?
33.6.
33.60 rounded up.
Okay, both of you broke up toward the end. If you don't mind repeating.
33.60.
33.6?
Mhm.
Okay.
Yeah. If
Okay,
rounded up.
okay. So 33.6 or 34% rounded. Okay. Again, be guided by, whether your financial institution wants the decimal point or they want you to round up to round figures. Okay. Okay, so let's look at GDSR. What would be our denominator, the bottom figure of our equation?
Would still be the 4,167, sir.
Yes, okay. And our numerator would be what?
That would be our mortgage.
850.
850, okay. Everyone else sees that? Because the gross debt is your housing, whether you pay rent or you pay a mortgage. So there's an $850 a month mortgage. So 850 divided by 4,167 gives us what? And multiplied by 100 gives us what?
20.3. 20.39.
20 point.
I got 20.4.
39 is what I got.
Okay.
20.39
20.39. Okay.
rounded up.
Okay. So 20.40. And because it's less than 0.5, you round down, so it'll be 20%. Okay. Now, most financial institutions, I should say most, some prefer that you show the percentage. I mean the decimal point, because it lets you know which way it is. Okay, whether they are under 34% or they are over 20% or under 20%, as the case may be. Okay, so my personal preference would be to show the decimal points. That's my personal preference, right? But again, either is acceptable, again, depending on what your financial institution shows. But for answering questions in the exam, you can do it either way. You can show the decimal point, or you can round it up or round it down, as the case may be. Just make sure that when you're rounding you round it the right way, okay? So we did say that we kind of discount CDSR nowadays, but if we were to consider the consumer debt service ratio, what would be the figure we use for consumer debt ratio? What would be the well, I'm jumping ahead of myself. What would be the denominator, the bottom?
Denominator would still be the 4,000. It would still be the 4,167.
Yes, okay. And what would numerator be, the top number?
Top number, including of loans and credit cards, would be, they're using both 350, 550, sir.
Okay, remember now your consumer debt servicing is your consumer loan and your credit cards,
Yes, sir.
because you have a $200 proposed payment here. So should you not add that?
Yes, sir.
So it's 550?
It's 550.
550, okay. So let's divide 550 by 4,167 and then multiply by 1,000. What do we get?
13.20.
Okay, I had an answer, but it was broken up. This internet is really bad tonight.
Excuse me. Is it 13.20?
Okay, I think I barely made out 13.2.
13.20, sir. 13.20.
Okay, so I heard correctly. Okay, so yes, 13.20, and because it's less than 0.5, we can round it down to 13%. Okay, so let's move on to exercise number 2. We're getting where we get to be a little bit more complex. We add another income, another source of income. Okay, so all right. So salaried income, 45,000 a year. We need to express that in a monthly figure, right?
Yes, sir.
Okay, so what would that be on a monthly?
3,750, sir.
Anyone get anything different?
So that's correct.
Okay, and remember we use 100%. We use 100% of that, right?
Yes, sir.
Okay. Now we have okay, of $1,500 a month, and we use 50% of that. It's already expressed monthly, so we only have so we know it's $1,500 per month, but we only use 50% of that, so we still have some calculation to do. What would that amount be if we're using 50% of 1,500?
750.
750, correct. Very good. And what would our total income be? Our total usable income, I should say.
4,500.
Okay, so our total usable income, and if I don't use the word usable going forward, when I say total income, we mean our usable income or our discounted income. Okay, so total usable income is 4,500. Okay, great stuff. So this person has a mortgage, $850 per month. What do we do with that?
That is already presented as debt, so we should just slide it over.
Okay, so that's already there. Okay, so 850. They have a car loan, $320 a month. What do we do with that?
We would present that as it is presented, sir, $320 per month.
Yes, very good. Okay, good. Okay, now we come to this little nuisance things here, these credit cards. Okay, so they have a Visa with a $1,000 limit, and it says use 5% of the limit. They owe $1,000. So we use 5% of the limit. It's telling us to use 5% of the limit. So what amount goes in that column?
50.
50. Yes. Okay. The next one is $2,000 limit with $1,700 owing. We're told to use 50% of the limit. What amount goes in that column?
100.
100. Excellent. Great stuff. Okay. There's a proposed loan, a personal loan of $300 a month. What amount do we put in that column?
$300, sir. You put the full 3 over.
We put the 300. Okay. And what is our total expenses for this client?
Would that be 1620, sir? 1,620.
1,620. Yes. Okay. All right. Good stuff. So now let's calculate TDSR. What would be our denominator? Our bottom figure.
4,500, sir.
4,500. Yes. And for total debt servicing, what would be our numerator, our top number?
Or 60 and 20.
Sorry, I'm just breaking up. Sorry.
60 and 20 would be the numerator.
Okay, 1620 would be the numerator, top number. Yes. Okay. So we divide 1620 by 4,500, multiply by 100. What do we get as a TDSR?
36%.
36.
36%. 36. Okay. 36%. All righty. So let's do the GDSR. Our denominator, our bottom figure is what?
$4,500 again, sir.
$4,500.
4,500. Yes. Again. And our numerator or top figure for GDSR.
850, sir.
Sorry. I just heard the 50 part. I didn't hear the first part.
Is it 850, sir?
Yes, 850, because that's the housing portion of the debt, the mortgage. So we divide $850 by $4,500, multiply by 100. What percentage do we get?
18.88.
Okay, 18.88. Anyone got anything different?
I got the 18.9. Well, I rounded, same thing, but I rounded off.
Yes, okay, all righty. So 18.88, 18.90, or 19%. And any of those three are acceptable. Okay. All right, so let's now do the CDSR. The CDSR. So our denominator would be what?
4,500.
$4,500, yes, okay. And our numerator would be what figure?
770.
Yes, 770, yes. So we divide 770 by 4,500, what do we get?
17%.
Yeah, 17%.
17%, yes, exactly, okay. Or if you want to do the 17.1, 17% rounded, okay, good stuff. Okay, so we're gonna move to exercise number 3. We added some more components to it, so we get a little bit more complex. Okay, so we add second person income, and we add the tips component to this one on the second person. Okay, so this the first person earns a salary of $35,000 a year, and remember we use 100% of each person of their primary job. So 35,000 expressed as a monthly figure is what?
$2,916.68.
Okay, so let's round that to $2,917. Okay. Now spousal income. So we know this is a married couple. This person has wages or base income, and they also make tips or gratuity. So we've been told to use 100% of the wages, and we use 50% of the tips or gratuities. And so their wages are $225 a week. So how do we calculate the monthly figure? What is the first step?
We timed it by 52 weeks and then divided by 12.
Okay, so we first multiply by 52 weeks, divide by 12. What figure do we get?
$975.
$975, okay, good. So now tips, they make $500 a week in tips or gratuity. How are we to calculate that? What is the first step or steps? Hello, can you, are you still there? Can you hear me?
Yeah, we using 50% of that. We gotta calculate that first.
So we say 500, what do we do with the 500?
We multiply that by 52 as well, right?
We multiply that by 52 to get the annual. Then we divide by 12.
And then
You get the monthly. So what monthly figure do we get when we divide it by 12?
$2,166 and
Right,
0.16 cents.
2,166. But we only use 50% of that. So 50% of 2,166 is what amount?
1,083.33.
Sound like someone was answering, but it got broken up.
$1,083.
$1,083. Okay, so $1,083. Okay, and what would be our total? What would be our total combined usable income? Can you hear me?
$4,975, sir.
4,975. Anyone get anything different? Okay, so $4,975 it is. Okay. All right, so let's move down to mortgage. Sorry, expenses. The first item is the mortgage, $750 per month. What do we need to do anything with that?
No,
We need to
sir.
further break that down, or do we extend it? Okay, all right, okay. Okay, car loan being repaid within 3 months is $800 a month payment. What do we do with that?
No, Mr. Nordich, that's some witchcraft that you put on the side there. Some witchcraft there.
Okay, well, let's say that we use it for the time being, because we don't know what the total debt servicing is, right? And it depends on if our financial institution allows us to this option, and if our financial institution allows us this option, do we really need to ignore this payment or not, right? Okay, but there's also another answer right off the top. This customer already has a mortgage, right?
Yes, sir.
Is the proposed loan a mortgage or is it a consumer loan?
Scroll down.
Consumer loan.
Consumer loan or personal loan, right? And we said that if your financial institution did use this option, it would be where there is a construction mortgage being considered, right?
Nah, Mr. Nordich, I understand.
Yeah,
Okay.
that's some sort of
Okay, earlier we said Earlier I said that if for construction mortgages, because the client for the first will for the first 6 months of the loan, when the loan is drawn down, is drawn down in stages because this construction is done in stages. So they are never going to pay the until that building is completed. Then they're not going to pay the full blended payment of principal and interest. They're only going to pay interest only until the loan is fully drawn down, right? So if you have a loan payment that is going to be paid within, say, 1 to 4 months, and that payment is going to take the client total debt service ratio over the 45% threshold, then you may want to consider excluding that payment, because after 3 months, that payment is going to fall away. And then, a month later or 2 or 3 months later, the full mortgage payment is then going to come into play. So there's not going to be a time when that full mortgage payment and that loan that's going to be repaid within 1 to 4 months rather are both going to be required. So you can discount the okay. And we said we consider that for construction loans. But I said I wouldn't get into the reason for that because there's a number of workings that I would normally go through to show you every month what the interest payment would be. Okay. But that was for more complex class, for more advanced class, right? But in this instance, what you need to understand in this instance is that the person already has a mortgage. The loan under consideration is not a construction mortgage, not a construction loan. It's a personal loan. So it doesn't matter that this loan is going to be repaid in 1 month, 2 months, 3 months, 4 months. We still need to use this payment because it's not a construction mortgage that's being considered. Now, if they did not have a mortgage, if they didn't have this $750, right, payment, and the proposed loan was a construction mortgage, then you might want to eliminate using the $800. Okay. I deliberately threw it in there to cause us to think, but you won't have any you won't have any questions coming up like this. Okay. It was just to cause us to think using what we've gone through so far in class. Okay. So in this instance, we will use the $800 because this is a construction mortgage is not being considered. That's the short answer. Is that understood?
Yes, sir.
Yes, sir.
Okay. Now, if we have time, toward the end of the course, and we have an extra half an hour or whatever it is, 20 minutes, half an hour, I'll go through it for those who might be interested. But again, don't concern yourselves with that. You won't come across this again in any homework assignment or the final exam. Okay. So it was just thrown in there to because it was something that was covered early in the book. All right, so we're looking at credit card. There's a $2,000 limit. In this instance, that we're being told to use 3% of the limit. They have $1,500 owing. What amount do we put in?
$60.
60.
$60, correct. Okay, $60. Okay, and the proposed loan is $400 per month. What do we do with that payment?
Not in play. Just got to put it on that sheet.
Okay, so $400 goes there. And what is our total expenses?
Is it $2,010?
$2,010, yes. Very good. Okay. Okay, so let's work out our TDSR. Okay, so our TDSR, what is our denominator?
That would be 4,975.
49.75.
Yes, 49.75, yes. And our numerator?
Numerator in this particular case would be $2,010.
Okay, so we divide 2010 by 49.75 multiplied by 100. What amount do we get?
$40.40.
Okay, 0.40. Okay, 40.40 or 40%, correct? Okay, so 40.4 or 40%, all righty? What we're gonna do is we're gonna look at that second, remember I emailed you 2 items. We're gonna look at the second one now. Charles and Irene Bow. We're not gonna spend time doing a GDSR. You can do that in your free time, but I'll provide those figures there for you. You'll get those in the email, in the PowerPoint presentation. Because going forward, we're really going to concentrate on the TDSR, right? So, so let's do Charles and Irene Bow, and we'll end the class with Charles and Irene Bow. Okay. So we have some figures in there. A typical question will look something like this, okay? And the areas that you are to complete will be shaded like this, gray or whatever. So you'll be guided because each one of these spaces to be filled in is probably worth anywhere from a half point to a point each, right? So make sure you fill in all the shaded areas when you're doing when you're doing a question like this. Okay. So so we have Charles and Irene Bow. Charles Bow has salaried income and he has gratuity income. Irene has salaried income and she earns a bonus. So let's look at the salaried income from Charles Bow. So Charles Bow, $400 a week.
Bouncing in and out, sir.
Three columns here to complete: monthly amount, the percentage used, whether it's 100% or 50%, and then we have adjusted amount. Okay, that would be the final amount. So we in here going forward, we move in stages. So the first column is monthly amount. So let's express $400 per week as a monthly amount. What figure goes in there?
Would that be $1,733.33?
Okay, so let's round it. So 1,733. And what percentage of that are we to use in calculating debt service ratio? What percentage of salary do we use?
For salary, we use 100%, the full amount.
Okay, so 100%. So that means it's 1,733 remains unchanged. Okay, good stuff. Okay, so gratuity, that's $425 a week. What is that expressed monthly? $425 expressed monthly.
Would it be $1,841.68?
Okay, so let's round that up to $1,842. And how much, what percentage of gratuity are we supposed to be using?
For gratuity, we
50%.
50%.
Okay, and so that amount will be what? In the adjusted amount column.
921.
921, yes. Okay. So use 50% of 1842 gives us 921. Okay, very good. So let's move on to Irene. She has salaried income of $2,250 a month. What do we do with that? In the monthly amount column,
We want the whole thing.
we just extend that there. Yes, okay. How much of that do we use?
All of it.
All of it, yes. So we use 100% of salaried income for primary, the primary job. But none of these people have secondary jobs. For each of the borrowers or co-borrowers. Okay, so now she makes a bonus of $3,600 per year, per annum. How do we translate that into a monthly amount?
Divide the figure by 12.
Okay, we divide it by 12. So we get $300, right?
Yes, sir.
And how much of that do we supposed to use? How much of bonuses do we use?
100%.
Sure, you sure? 100% of bonuses?
50%?
It's a per annum. So I would think that we use the full thing.
The second point at the top of page 32.
That would be 50%, sir. Tips and bonuses.
What does it say?
Gratuities
Tips
/
and bonuses, use 50%.
Yeah, I see it.
Okay, great. Okay, good stuff. And what would that amount be if we use 50%?
150, sir.
150. Okay, great stuff. So now they get rent from a triplex at $750 per unit. And it shows us 1,500. Is there anything peculiar here?
That's only rental for 2 units, even though they have 3.
So what may that be telling us?
One of the units is vacant.
Or that they, well, not so much vacant, but that they occupy one of the units.
It's not a tiny little too vague there because it could be either or.
No, because remember now, the reason we use 50%, is to allow for times when the apartment is off rent. Okay? But in an example like this, where we remember what we said, if it is only occupied, we only use the rent from two units. Okay? Because like I said, vacancy is already taken care of by using 50% of rental income. Understood?
Yes, sir.
So basically what this is telling us is that they're living in one of the 3 units, and they're only getting rent from the 2 units. Okay, so we have not been given the write-up. We only just been given the sheet. But if there was a write-up on it, the write-up would have been would have given us that information. Okay, so what amount do we put there in the monthly amount column?
750, sir.
Sorry,
Would that be $750, sir? 50%.
in the monthly amount.
Yes, sir.
No, in the monthly amount. What amount goes in the monthly amount?
1,500.
1,500. Okay, because we're told that they make $1,500 a month. So we look at the monthly amount first. Okay, then we look at the percentage used or adjusted amount. So in this instance, we use 50%, and that's where you'll get your $750. Okay, so they make this amount, whether it's weekly, monthly, per annum, or whatever it is. We have to convert it to monthly. If it's already monthly, we use it as monthly. Okay, so these two are already monthly. So we, Irene salaried income and rental income is already monthly. Okay. And what is our total adjusted amount, total income adjusted amount column?
Is it 5,804?
Yes, it is. $5,804. Okay, so that's our total adjusted income or total usable income, depending on what terminology you use at your financial institution. Okay, so this $5,804 is the total amount of income that we're going to use to determine debt service ratio. Okay, so now expenses. There's a mortgage on the triplex residence at Finco, and see that's another thing that gives us a Q, is a triplex residence. Okay, not just a triplex. The word residence is in there, which lets us know that they are residing in one of the units. Okay, so if you didn't get it right up there when you get down to here, pay attention to what the words are saying, and that will help to guide you. Okay, so they're paying on that triplex by way of mortgage, $1,250 per month. So what amount goes in here in the this monthly column?
$1,250 because it's already given us the monthly amount.
Right, and the adjusted amount? Don't overthink it now. Don't overthink it.
Would it still be the 1,250?
It'll still be $1,250. Yes. This portion of this portion, when you come to the expenses, this adjusted amount is where you can pick up some easy points. Okay. Once you get that monthly amount correct, the adjusted amount should automatically be correct. So this way you can pick up some easy points. Okay. They have a car loan at Commonwealth Bank where they pay $575 a month. What goes in the monthly amount?
That'll be
$575.
Okay, and then the adjusted amount?
the same amount, sir.
Sorry?
That'll be the same amount, sir. $575.
Okay, Oh, let me just point out something. As a kind of cheat sheet, remember we were looking at bonus? To the bottom here, you see a legend, right? The legend says salary, use 100%. Rental income, gratuity, or bonus, use 50%. Credit cards, all use 3%. Okay? So at the bottom of each one of these, there's a legend that tells you what to do. Okay? So and that'll be in all of your any exercise going forward. Homework, final exam. Okay? So you don't have to remember, oh, on page 32, the second point said use 50% bonus. The information will be provided. Okay. And the reason, some people say, why are you making it easy? But the thing about it is when you're sitting at your desk, chances are you have all these tools to tell you what amount to use, et cetera, et cetera, et cetera. Okay. So I'm more concerned, are you getting the end result, this adjusted amount, rather than focusing on whether it's 100%, 50%. Now, I want you to put in the percentage use amount for the incomes to kind of trigger to you, hey, do I use 100% or do I use 50%? Or what percent do I use? Okay, so I have built in a trigger to help you to get to this point. Okay, so the whole point is to move you from point A to point B to point C, so that you can get to the end result Z. Okay, and this is how we progress, and this is why I've done this chart this way. Except for that, what you call the witchcraft thing on exercise number 3, about the 3 months being paid off, except for that, throwing that little thing in there, which again, we can reason through. You won't have any of those kind of sidebars. Okay, so you'll have these shaded areas. So if you don't fill in a shaded area, you're already losing whatever points allocated for that, whether it's half a point or a point. Okay, you'll have a reminder as to what you should use down here under the legend. Okay, so having said that, we move now to credit cards. There's a Visa card, there's a $2,000 limit. What amount goes in the monthly amount column? Can you hear me? Oh.
For we on the First Caribbean Visa, right?
Yes, the $2,000 one, yes.
Okay, that's $60.
$60.
Okay, that's $60. And then the amount?
Be $60 as well, sir.
Would be $60 as well. Okay, great. Okay, on the RBC Visa $3,000 limit, the second one, what amount goes in the monthly column?
That's $90. Mr. Nottage.
Yes,
That's $90.
Okay, 90, correct? And what goes in the adjusted amount?
$90 as well, sir?
$90.
90 as well. Okay. So let's have a shot now at the third one.
The same,
Sorry, go ahead.
that's $150.
$150, yes. And the adjusted amount?
It's the same.
It's the same, okay? So it might be like I'm stating the obvious, but I want to make sure, we got it down packed because I want all y'all to pass your final exam and pass this course. Okay, so we have one more item under expenses, and that is a personal loan. $525 per month. What amount goes in the monthly?
$525.
$525, and in the adjusted amount? Same thing, okay. And what is our total, excuse me, our total expenses?
That'd be 2,650, sir.
2,000,
650, sir.
yes, 2,650, yes, okay. And calculate the TDSR.
Sir, is it 45.65%?
45.65.
5%.
Okay, or you could round it 45.7 or 46%. Again, the maximum TDSR is 45%. So that is why I prefer to use your decimal points. So you'll see that some people round it to 40. So it comes across that okay, they're whole full 1% over the maximum allowable, but 45.66 or 45.7 don't sound too bad. It sounds better than 46%. But either one of those will suffice. Okay. So 45.66 or 45.7 or 46% rounded up. Okay. So what I want you to do is to see it on your own, which you could do with Martin and Sherry Roll, page 106, in their and we'll go over it in class on Thursday. Okay, so go through Martin and Sherry Roll on your own and see how much of it you could do on your own, and calculate the TDSR on it. Okay.
That's for Thursday, sir?
Yeah, I'm just saying in preparation for the class on Thursday, we'll do this in class. This is not to be graded. Normally we'll complete this in class. But I'm gonna end class here for the night. Probably another 15-20 minutes we could complete it. But I have to end class here for the night, unfortunately.
Okay, sir.
Okay.
All right.
So if you do,
Okay.
I mean, if you do, you're ahead of the game. If you don't, no sweat loss, because we're gonna go through it in class anyhow. Okay.
Yes, sir.
All right. So everyone have a very good rest of the evening, and I'll see you again on Thursday.
All right. Good night, all.
Good night.
Good night.
Good night.